Yeah, I could see it. Yeah, well, we could probably start now, and then we'll people roll in. We'll have them roll in. I'll just submit them. But well, just so I wanted to thank all of you live and on YouTube and social media. Thank you so much for joining us. I'm Ivan Estrada. I'm a residential broker at Douglas Elliman with a background in accounting. So obviously, cost segregation is all about it. I nerd out anything when it comes to numbers and data. That's my jam. And so that's why I wanted to bring Greg today because you've heard this before, especially if you have investment properties, commercial property, and of course, nobody likes that word taxes. It's a bad word. I hate it. And we all want to pay the least amount possible. And so that's why I wanted to bring Greg, who was an incredible person who was actually introduced to me through my business coach, Aaron Keith, who I've been working with for about, I want to say, 12 years. So anyone that is good friends with Aaron is obviously good friends with me. And so, Greg, before I kind of read your bio, I just wanted to say thank you so much for joining us and for bringing in all that knowledge because I'm sure there's going to be a lot. I'm ready to take notes. And so I just wanted to welcome you.
Yeah, appreciate that. I appreciate the opportunity to be here and to share this opportunity with you and your clients.
Awesome. So, a little bit about Greg. I'm going to read his bio. So, Greg is a founding partner and has over 35 years' experience in accounting, tax, and business consulting, primarily with Deloitte and KPMG. As a member of Deloitte National Tax Consulting Group, he was responsible for serving and advising Fortune 500 clients throughout the country, focusing on income tax planning, merger and acquisition consulting. During his tenure at KPMG, Greg was responsible for assisting both public and private clients with a variety of value added accounting, tax, and business consulting strategies. Greg holds a BS degree in accounting from Indiana University of Pennsylvania. So, I mean, you're definitely the guy, Greg.
I appreciate it. Before we jump into this, I mean, I'm not sure if you want to talk, give any type of update on just the market in general. That's up to you. Your call.
Yeah,
Yeah.
let's do it. So, like I said, for those of you that know me and don't know me, I've been a residential broker in Beverly Hills now for close to 16 years with a background in accounting and finance. And it's a weird market, Greg. It depends on who you ask because every agent in the same office with the same experience is going to give you a completely different answer. But I'm going to give you from my perspective and also from a lot of the knowledge that I've acquired from other brokers on what's currently happening in, I would say, the LA market and then the California market as a whole. So when it comes to Los Angeles, there's still a big demand for single family homes under $2 million. So that's a three bedroom, two and a half bath, 1,700 square foot home. If it's in a good area, Studio City, Sherman Oaks, and I'm naming areas where you can get a house still for under $2 million. Eagle Burbank, there's parts of West Hollywood where you can get a house for under $2 million. I mean, those are still doing very, very well as long as they're priced well. It's all about price. Those homes are still doing really amazing. Condos, on the other hand, not so much. So the condo market, there's a huge amount of inventory out there. Also, lenders are having quite some difficulties when it comes to lending on a lot of condominium buildings, just because for those of you that know or don't know, a lot of the condominiums that have balconies, people are having to get assessed to run both an inspection and reconstruction if any of the balconies need to be reconstructed because of what happened out in Florida a couple of years back. So condo market not doing that great. Single family market doing pretty well, under 2 million. Then when you get from that 2 million to the 5, $6 million range, it's pretty slow unless you have something that is just move-in ready, designed really well, doesn't have any weird quirks at that. So if it has too many stairs, probably not going to happen. If it doesn't have its own garage, it might be something that might be a little bit difficult. If every bedroom doesn't have its own bathroom, that might be a problem. So It's all based on price, floor plan, and neighborhood. And then you have those multi-million dollar homes. So those are actually doing pretty well. Properties that I've sold over $10 million still doing really well. There's a lot of transactions in the market, uh, a lot of money moving in that market, mostly from, I would say, people within the US, not a lot of foreign buyers, at least from my perspective. And then when it comes to California, again, different neighborhoods, different pockets. We're hoping to see an appreciation, minimal appreciation of about 2 to 3% this year. Obviously, some neighborhoods will see a lot more appreciation than others, and some will actually see um, either prices staying the same, or in some areas, prices will go down by a couple of percentage points. It just really just depends on the micro market that you're in. But when it comes down to the interest rates, I think that's going to be very telling for our market. If we're now seeing 5.9, 5.95 on certain 30-year loan products out there. And so if we see at least, I'm hoping for a rate cut or two this year, and that will really kind of boost the market, in my opinion, at least in that kind of $5 million, $2 to $5 million range that's kind of just sitting there a little bit. I think that'll really change up the market. So I'm optimistic. I am in the business, so I want to remain optimistic. It's been a great year for me. It's been a great year for my office, and I think that, as long as, the numbers when it comes to interest rates, and obviously I'm watching the CPI report, the inflation report, and just hoping that inflation cools down because that's what every realtor is praying for.
Yeah, for sure, for sure. All right. Well, hey, appreciate that. So, and again, thank you all for the opportunity to be with you today. And the agenda that we have set today is I just give you a little introduction on myself and our firm, but then look at some tax planning opportunities for folks that are investing into real estate, commercial and residential rental properties. So and so we're primarily talking about cost segregation, but then what we'll dive into is there's different tax saving aspects that are tied to cost segregation, right? So we got bonus depreciation, 179 expensing. As part of the big beautiful bill, there's a new category called qualified production property. We'll touch base on that just briefly, but then we'll also talk in a little bit more detail about short-term rental property as well. Now, we're going to hit this all at a high level. So I guess let's begin. So Think LLP. So we are a national tax consulting practice, but our niche is federal and state tax credits and tax incentives. So we're ex Big Four, national office tax partners, CPAs, attorneys, consultants. So we started this firm. I'm one of the founding partners. Like Ivan mentioned, my background is KPMG and Deloitte. And we have built this practice around teaming up and partnering with local and regional CPAs across the country that don't offer our specialty tax services, right? And they look to us to do these specialty tax services. Then we team up with your CPA. So I can't stress enough that anytime that you're doing any type of specialty tax project, we always want to make sure your CPA is involved with that process. And I'll explain that a little bit later. But we service all kind of companies, from small pre-revenue companies to again, real estate investors who are buying single family rental properties, all the way up to some of the largest of the Fortune 1000. Here's an example of some of the companies that we have consulted with over the years. So as you can see, it's a pretty broad client base. Now, we operate in two areas. There's federal and then state and local tax. today we're going to be talking again, focusing more on the cost segregation piece. We also get into other areas, R&D tax credit, export tax incentives, so on and so forth. All right, so cost segregation. What is it? So cost segregation, it's an IRS sanctioned technique, right? So this is nothing new. It's been in the tax law. It goes back to the 70s. But back then it was called component depreciation. But it has evolved over the years. Early on, when you're looking in the 70s and 80s, there was definitely a lots of court cases that were out there that has led the, kind of set the tone for, what cost segregation is today. So it's an engineering analysis of real property, and so it involves analyzing everything from purchase documents. If it's new construction, we blueprints, looking at all of the construction costs, and what we're gonna do is we're gonna bifurcate those costs into different buckets. So here's how it works. Here's a good picture that a picture is worth 1,000 words, right? So typically what happens is when you invest or into real estate, commercial or residential rental property, you're either going to, without doing cost segregation, you're going to do straight line depreciation, 39 years or 27 and a half years. So 39 years is for commercial buildings. 27 and a half years is, is residential rental property. So what cost segregation does, it again, it's that engineering analysis of the building, and instead of just doing straight line depreciation over the life of the building, we're going to carve up the building into 5, 7, 15-year depreciation. So we're going to accelerate those tax deductions. Now, keep in mind, depreciation is depreciation, right? So this is a time value of money play. So what is your tax deduction worth to you today versus 20 years from now or 30 years from now? That's the concept, right? So you accelerate your tax deductions, you write a smaller check to the federal government as well as the state governments, and then you take that money, that tax savings, and you put it to work for you, right? So it's what is the value of that tax deduction today? So that's the concept of cost segregation. Now, here is an example of different types of properties, and on average, right, what kind of range of the value that's given to the building, to the structure, that can be accelerated into shorter depreciable lives. Like, for instance, apartment buildings, right? So you got to carve out the land, right? Because you can't depreciate land. And then whatever the value is of the building, then you can look to probably, accelerate 20 to 35% of that building into shorter depreciable life. Right. So this just kind of lays out, give you a range, so you have an understanding of what we're talking about here. So again, and this applies to all types of real estate, right? It could be acquired property, new construction, it could be remodeled property, or if you're going to expand and build out or add to an existing property, you can also do cost segregation on all of that. So what happens? So I'll go back to this slide here real quick. So let's use an apartment building as an example. So let's say that you buy an apartment building and you spend $5 million on it. And let's just say that land is $1 million, and then now you got 4 million, and you're going to accelerate 20 to 35% of that 4 million into shorter depreciable life. Okay. Then what happens, the way that the current tax law works, there's this concept of called bonus depreciation, right? So anything that gets accelerated into shorter depreciable life is eligible for 100% bonus depreciation. Okay, and this was all part of the big beautiful bill. And so if I accelerate that building that say 20 35% into 5 year, 7 year, 15 year, I don't even have to depreciate it over 15 years. I can make an election to write it all off in the first year under bonus depreciation rules. And this is a permanent part of the tax law. And it applies to anything that gets accelerated into shorter depreciable life. So qualified improvement property, personal properties, site improvements, all of that, you can all write it off in year one. That's a huge benefit. Now, going back to an earlier comment about having your CPA involved, this is the important part, because just because you generate a very large tax deduction doesn't mean that you're going to use it all in 1 year, right? So what happens if you generate a big tax loss, right? Then you have to look at utilization of that big depreciation deduction. And that's where your CPA comes into play, because it all depends if it's considered passive versus active, right? If you're a real estate professional, right, you can use this to offset all forms of income. So there's a lot of moving parts on this, and that's why it's so important to have your CPA as part of the process. Now, another section of the tax code comes in. It's called Section 179 expensing. Right. So what happened under the big, beautiful bill, it increased the expensing limit to $2.5 million. So there's a cap on this. And so what does this mean? So, and this is applicable to non-residential rental property. Right? So this is going to be commercial property, 39-year property, right? So if you are doing roof repairs, you're replacing the HVAC system, and this could be components of the building that would be considered long life, you can actually use Section 179 to write it off, up to the cap, right? So there's an interplay with 179 and bonus depreciation, and which one you use will actually depend upon state tax law as well, right? Again, this is why it's really important to have your CPA involved in this right from the get-go, right? So that they can advise and they're aware of what's happening and make the right elections for you as you're investing into commercial real estate. Okay, and then here's another area, right? So there's another part of the tax law, and this is for what's considered qualified improvement property. So if you meet the definition of qualified improvement property, this is all 15-year depreciable life property. And so what does that mean? That means it's eligible for bonus depreciation. So even though it's something that's 15 years, you're going to be able to write it all off in 1 year, right? So this is only applicable to commercial properties, not residential properties. But so what is qualified improvement property? It's any type of improvement that was made to post-acquisition improvements that you did after you acquired the building, and you're going to again you're doing an interior remodel, right? So it includes everything on the inside that's non-structural related, so drywall, ceilings, acoustic ceilings, certain types of flooring, carpeting, paint, right? It doesn't it's not structural in nature. So it's not the roof, it's not exterior walls, things like that. So what happens is once you buy a piece of a commercial real estate and you do these improvements, high probability, if the improvements are non-structural, again, you're going to be able to write it all off in year one. So that's it's a big benefit. In order, again, you're accelerating those tax deductions. It's a meaningful write-off. I want to just touch base on this real quick because as part of the big beautiful bill, there's a new category that was created, and it's called qualified production property. So, and this is all part of the incentive put into place to bring domestic manufacturing back into the U.S. Right? Well, to bring manufacturing back into the U.S. So it's encouraging construction of new, manufacturing properties, new refining properties, And so it's a big incentive. So what does that mean? So if you're building a new factory or making a significant expansion into a new manufacturing facility, or doing major renovations where you're expanding, and you can basically, you're going to write off the majority of the building, anything that's production related. So the only thing that you wouldn't be able to write off in the first year is anything that is administrative in nature, like the reception area, and maybe some upfront offices. But all of anything related to production, the manufacturing part of it, and the shipping part, right? That's all going to be considered qualified production property. It's a big incentive for companies that are looking to expand their manufacturing capacity here in the U.S. Now, there are some drawbacks, meaning that the property, like if I build a new manufacturing facility, it's got to be used as a manufacturing facility for a 10-year period. If you don't, there's this whole concept of recapture. And that means that you're going to have to recapture all of that depreciation that you wrote off in year one. Um, on the point of recapture, let's talk about that real quick too, right? Because again, when you're doing cost segregation and you're accelerating all these tax deductions, right? You want to make sure that you don't have to recapture depreciation, meaning that if you're flipping properties, right, cost segregation may not be the right strategy, absent a 1031 exchange, right? So these whole recapture rules have been put into place to keep people from just generating a bunch of tax deductions and then selling that property, right? So because if you do that and you flip it and you don't do a 1031, all of that depreciation you wrote off, you're going to have to recapture at ordinary income rates. So again, goes back to the earlier comment about having your CPA part of the whole process to make sure that everyone's on the same page of what you're doing from a tax planning standpoint. All right. This short-term rental properties. This is an area that has getting a lot of traction because of the VRBOs of the world and things like that. So if you're buying rental property, right, and your average period that your kind of your customer use is 7 days or less, right? It's considered short. It can be considered short-term rental property. Okay, so short-term rental property is not considered a rental activity. It's considered a trade or business. So, as long as the taxpayer can meet the materially participates tests, and you have to meet one of the tests. So what does that mean? What's the benefit here, right? So if you check the boxes for short-term rental properties, you can use all of the depreciation deductions that are generated through cost segregation to offset W-2 income, business income, investment income. There's no limitations to as to what income you can offset. But the key to this is that you have to materially participate. And so there's one of three tests, which are the common paths. But the test I want to focus on is the 100 hours and more than other individual, because that's typically the test that's being used to be eligible for this. Because what happens is when you're looking at this test, you're going to look at your activities that you're doing as an owner, right? So guest communication, development pricing, cleaning, repairs, contractor management, bookkeeping, any type of travel related to operations, right? When you start looking at that 100-hour test, you're going to look at all these different areas. But you got to make sure that as an owner, you're spending more time doing these types of activities than any third party, right? So if you're outsourcing the cleaning or the property management, to third parties, and they're spending 120 hours, you need to spend over 120 hours. If there's, but you just have to be 100 hours plus, again, more than any other third party. So we're seeing a lot of these types of projects right now because people are investing into, single family homes or condos down by the beach, and they're putting them out as short-term rentals. Again, there's a lot of communities that are trying to stop that, so you just got to be aware what you're getting into there. But that, again, another big area that you need to think about when investing into residential rental property, if you're going to do short-term rental or long-term rental. I just gave you a couple examples here of what this means, right? So, and I just, threw out a couple different buildings, so like the recent study we did was a single family rental property, $4 million acquisition. We generated, almost $2 million of bonus depreciation in the first year. So I threw a lot out at you. I didn't want to, dive into a lot of the tax technical aspects of it, but just to make you aware of, what's out there. And we're here to answer any questions. And we can, like I said, the way we go about these projects is we always pull your CPA in. We gather information on the front end about the type of property you've acquired, and then we will perform. We'll give you an estimated benefit analysis of what you can expect. You can take that estimated benefit analysis back to your CPA and sit down with them and say, okay, if I do cost segregation and I generate all of this depreciation deduction, what does it mean to me, right? What's my utilization look like? How much tax will I be able to save? And you do that on the front end before you even hire us to do the project. And regardless of working with us, or your CPA may have a relationship with somebody else that does this. You just got to make sure that your CPA is involved. I just can't stress that enough. So I guess I'll open it up to questions.
Thank you, Greg. That was great. So I have a couple of questions, and then if V or anyone else has a question. So who is and who's not like the perfect candidate for cost segregation? Because you did mention if you're a flipper and you're holding it short term, unless you're thinking about a 1031, then this is probably not ideal for you. So who would be the best candidate for this, and who probably wouldn't be?
Yeah, again, we've done projects, we've done cost seg projects on properties as low as 750,000. Where you're buying, a residential, property, right, in the Midwest, right? It's hard to find a property in California at 750. But so from an acquisition cost standpoint, once you start getting below 750, a half a million, the benefits get marginal from that standpoint. And then again, if you're a flipper again, you're flipping and not doing 1031, probably not the best strategy. If you're buying real estate for a long-term hold, or if as part of your real estate investment plan is you're always going to do a 1031 because you want to continue to trade up, those are great candidates for cost segregation.
Awesome. And what about, like, for example, I have clients who own their companies, their headquarters are here in the US, but they have production plants, let's say out, in Mexico, right, where they make a lot of the product, and they wanted to do some cost segregation for some of their warehouses in a different country. Is that possible, or does it have to all be within the boundaries of the US?
Yeah, from our standpoint, we operate within the U.S. So we're not familiar with other foreign jurisdictions, their tax laws and things like that. And typically, what happens is a lot of local and regional CPAs and this has changed over the years, where they may be part of a CPA association that has, that's a worldwide, where there's member firms in the UK or member firms in Mexico, right? So, and then what they're able to do is tap into their
Mm,
association members, right, in order to get a better idea of what are the tax laws in these foreign jurisdictions and how they can benefit. Obviously, right, the big four, they're worldwide. They got offices all over the world.
right, right.
They could just pick up the phone and call their office in Mexico and in Guadalajara or whatever. Whereas local and regional CPAs don't have that, but that's why they joined these international associations to be able to offer that type of expertise, to bring the expertise to the table for their clients.
Got it. Okay, perfect. And I definitely understand what depreciation recapture is, but for those of the people who are watching who may not understand that part, when you say there's going to be some depreciation recapture if you sell it within a certain time period, and it's going to be taxed, you said at ordinary income.
Or income rate, yeah.
Um, so explain that a little bit more thoroughly.
Yeah. So what happened? Let's just use an example. Let's say you bought a piece of real estate and you did cost segregation and you accelerated $500,000 into shorter depreciable life, and you made an election to write that all off in 1 year, bonus depreciation. You wrote off $500,000, and let's say in year three or even just a year or two, right? You flip that property, right? So the IRS, they're going to say, well, you're going to have to recapture that depreciation, meaning that what you just wrote off, you're going to have to pick up as into income in the second year, right? Anything above straight line, right?
Mm,
So when you look at it, so the shorter the time period of the flip, the bigger the recapture is going to be, right? So if you held it for 5 years, right now in 5 year, straight line depreciation, the difference between accelerated and the straight line, that's going to shrink, the longer that you hold a piece of property, right?
mm,
So again, absent a 1031. So all of that, whatever you accelerated, you're going to have to recapture at ordinary income rates, because think about it, when you wrote it off, that you wrote it off as it was an ordinary tax deduction versus
mm.
capital gain, right? So capital gain's a different tax rate from ordinary income.
Got it. And then my last question, and just a clarifying question that I got from a friend, and then if anyone else has any other questions. You mentioned that cost segregation has been out there for a long time, since the 70s, but all of a sudden it's like a buzzword, or you're kind of hearing it a lot, probably because of the big beautiful bill. Like, why is that? Is that just that is there more incentives now because of this big beautiful bill, or is it just, it's always been around and the rules have still kind of all been the same over the last couple of decades?
Yeah, I mean, the rules have been the same. But what transpires is the whole bonus depreciation.
Hmm.
That has changed over the years. So for instance, going back to the 2017, Trump tax cuts, right? They had bonus depreciation in there, but then it started to phase out, right? It went from 100% down to 80%, down to 60, down to 40, and we were down to 40%. And
Hmm.
then and that was always a temporary part of the tax law, right? Meaning Congress always had to renew it. So as part of the big beautiful bill, what happened is that whole concept of bonus depreciation was made permanent at 100%.
Hmm.
So it's locked and loaded unless there's going to be
Hmm.
another significant tax law change that Congress has to vote on.
Got it. Okay. Um, does anyone have any questions? Doesn't seem to be. Okay.
Yeah.
Well, this is great, Greg. This is incredible presentation. And like I said, if you're watching it online, this could be something you could share with a friend who owns commercial property, income property, or if they're thinking about it and they want a little bit more knowledge about what cost segregation is. And obviously, Greg, I would love people to use you. Like I said, you're good friends with Aaron. Aaron's like a brother to me. So if you're good friends with Aaron, obviously you're good friends with me. So what's the best way that people can reach out to you? We'll definitely put your information in the details of the video, but your email, website, and phone number, anything else you'd like to share.
Yeah. So my phone number is area code 760-473-2456. That's my direct line. Feel free to call me there. My email, and it's in the presentation on the last slide. I just didn't get to it, but it's first initial, last name. So G Elias, Elias at think THINK LLP.com.
All right, Greg. Well, thank you
Yeah.
so much. And for those of you that watched, thanks for being here.
Yeah. Thank you. Appreciate it. Have a great day.
Thanks, Greg. Bye.
Bye.